Good morning, and thank you for joining our webinar today. Today, we are here to discuss managing cash flow. I know this is weighing heavily on everyone's mind right now as we are dealing with the impact of COVID-19. Given the importance of cash flow in times like this, you should be immediately developing a treasury plan for cash management as part of your overall business risk and ability to stay open through this crisis. We hope that some of the tactics we offer today will assist with this. My name is Sydney Lynn, and I am joined today with Brian McCaig. Brian and I are client advisors at RSI. Our client advisory department offers a wide range of strategic, financial, and operational consultation services for our clients. Feel free to reach out to us at any time for more information on these services. The purpose of our webinar today is to discuss forecasting profit versus forecasting cash. We're also going to discuss the importance of accurate financial statements and more specifically the balance sheet. We're going to review cost cutting of essential versus non-essential expenses. And we're also going to discuss current and long-term debt service planning for expenses that have been overdue or may have been deferred. So I think that is a perfect time for us to have our first poll question. Brian, what's our first question today?
Absolutely, let's get into it. And we're going to do a few of these poll questions throughout the webinar today. It's a fun way to interact, so it'll pop up on your screen, you'll be able to answer, and then we'll talk about those answers and how they relate to what we're talking about right now. It's also a good time to remind you that there's a Q&A section of this webinar, and we encourage you to get your questions in. We're going to try to save some time at the end of the presentation today to address those questions, so the more you interact, the better, so we encourage it. That being said, let's jump into poll question number 1, which should be up on your screen now. How confident do you feel understanding and forecasting your restaurant's cash flow? You may say very confident, somewhat confident, or not confident at all, and that's why I'm here. Okay, Sid, so the answers are coming in. I want to give everybody a chance to get the answers in, so I'll leave it open for another 10 seconds or so. And it looks like a little bit of the mixed bag. I'm going to go ahead and end the polling. And Sydney, my takeaway is nobody was very confident, not much of a surprise. And the rest were kind of a mixed bag between somewhat confident and not confident at all. They came to the right place, huh?
That is exactly why we're here today. So glad you're with us, and hopefully we can help address some of those questions that you might have.
Absolutely. So let's jump into kind of the theme of today's call, and it's flattening the cash flow curve. We've heard a lot lately in the news about flattening curves. This is obviously a different kind of curve. Think of any business throughout the year. Managing that bank account balance is a really tough thing to do. There's lots of events that happen throughout the year that make your bank account balance go up or down, and making sure you're above zero and not drowning is a crucial part of anyone who's managing a bank account for a business. My belief is it's especially hard for restaurants. So there's events for restaurants just with natural seasonal fluctuations that make this really challenging. As an example, Q1, a lot of restaurants they have the revenues a little lower because of a holiday hangover. The customers who are coming in are redeeming gift cards from all the gift cards that you sold during the successful Q4 gift card promotion, and that's great. That's bringing people in. However, that's not great for your cash flow because it's not new money coming in, right? So Q1 can be tough to begin with for restaurants. And this year, obviously, COVID-19 dropped a grenade on everybody's plans and made it even tougher. That being said, Q1 for a restaurant can be a really good time to dip into loans and maybe leverage some of that debt. Conversely, Q4, maybe you have a busier holiday sales. And you're having gift card promotions, it can be a better cash flow quarter for restaurants. And that may be a good time to pay down debt or maybe a good time to pull the trigger on some of those capital expenditures. So we'll talk about a lot of the tactics today that can help flatten that curve, but the idea is to be able to be proactive, keep yourself above zero, and be smart about forecasting that information. We're talking about doing it throughout a year. The thing with restaurants is a lot of them even have to manage their cash flow day to day because you're trying to plan for those heavy credit card deposits from the weekend coming in at the beginning of the week and figuring out when that aligns with your paycheck or big expenses. That's why it's a good reminder at RSI, we always recommend a weekly payroll rather than a bi-weekly payroll, so you don't have that spike in payroll expense every 2 weeks. It's another way to kind of flatten the curve throughout the week. Lots of things restaurants have to think about there. The spoiler is, this is always going to be a challenge for restaurants, but like I said, today hopefully we give you some good tactics to be a little more strategic when trying to forecast that cash flow. All right, and tactic number one is going to dive into managing your P&L. And whenever I talk about managing your P&L, especially from an operator standpoint and managing that profit, we're going to talk about forecasting and budgeting. So remember, operators should be forecasting sales before making decisions on staffing levels, before making decisions on ordering par levels. An operator who's good at forecasting ends up being good at managing those costs of goods and that labor because they're really thinking about how that forecast impacts what they're scheduling for and what they're ordering. This is a good time for me to remind everybody, when you're talking about forecasting, when you're talking about budgeting, a break-even analysis is crucial here. And not just a break-even analysis for your P&L, not just a break-even analysis for your profitability. There's two kinds of break-even analyses I want you to consider here. First, do a break-even analysis on that profitability, on your P&L. If I hit these key metrics, this is what I would need to do a week in sales to break even, to make $0 in profit. I know that's not the goal, but it's a good number to know of, hey, what is that threshold? What is the sales I need to do to be able to break even from an operational standpoint, from my P&L standpoint? And then use a lot of those same metrics and run a break even that's factoring in cash flow, that's factoring in the debt you're having to pay down, those loan payments, those kind of things. So that now you have two numbers in your mind. You have one number of, hey, what's my profitability break even? And one number of, okay, cash flow wise, how can I break even? And maybe it's only a temporary situation that I'm paying off loans in a really heavy way, but knowing those two numbers and having that trickle down to your budgeting is crucial. So it gives you a good sense of your business. Sid, you and I in the past couple months have probably done more break-even analysis with clients than our whole careers combined. I'm not complaining. That's a really good thing. Right now, restaurants should be leaning into this number and understanding, better than ever at a more granular level, all the financial aspects of their restaurant. So I'm not complaining, but it's definitely been a busy couple months doing break-even analysis. And if you're interested in that, we're trying to help as many restaurants as we can. So our contact information will be throughout this presentation. And again, at the end of the presentation, don't hesitate to reach out to me or to Sydney if you're interested in doing a break-even analysis. We're happy to help. All right, let's continue on. So we talked about forecasting. Now I also want to talk about budgeting. And budgeting, how it is a really important step in forecasting your cash flow as well. So yes, creating a budget has a ton of benefits. It helps your team understand, your expectations. I want you to hit this metric for food costs and this metric for labor. And it helps get the operators engaged. But it also, because you're forecasting your profitability period by period, profitability has a big impact on your cash flow. So it also helps you 30, 60, 90 days out understand, okay, here's where my profitability is going to impact cash flow, and based on seasonal fluctuations, this is my profitability in period 2, this is my profitability in period 3. How does that factor into everything else? You should be asking yourself those questions, and it will aid you in forecasting your cash flow. Sid, we did a fun webinar on this recently, and that webinar, if you weren't able to attend, that webinar is available in education and training. The recording of that webinar is a fun one, although I am a dork when it comes to budgeting, but I had a lot of fun, and it's available to everyone if you're interested, and you can reach out to me and Sydney for help with that as well. Okay, so forecasting and budgeting, crucial step in managing P&L and profitability. Sydney, that's not the only statement you need to consider when you're thinking about cash flow though, right?
Absolutely not. It's definitely important, and it's important that it's accurate, especially if we are doing a break-even analysis. But actually, the most important financial statement of them all is the one that most often gets missed, which is the balance sheet. And anybody that's worked with me that's on this call knows what a stickler I am about the balance sheet. The balance sheet, if it's not accurate, then your P&L isn't accurate, and often not in your favor. Inaccuracies could lead to cash flow problems. So it's really important that you're verifying the balances on certain line items on a consistent, regular basis. So let's kind of go over the assets and liabilities and what you should be looking at. So when reviewing your current assets, you want to make sure that the house bank truly reflects the balance of cash in your restaurant. And as of right now, you may not need as much cash sitting in your petty cash as you have pre-COVID. So this could be a good opportunity for you to reduce the amount of cash in your restaurant, put it back in the bank account, so that way you have that in there to be able to pay bills. You also want to look at any of your house accounts or accounts receivable that you might have outstanding. Make sure those balances are accurate, but also make sure you're reaching back out to the people that owe that money to you and start collecting it back. Again, it's cash outflow that is sitting out there waiting to be an inflow. So make sure that you're getting those balances paid back to you. When you're reviewing your liabilities, certain things that you want to keep in mind. If you are paying credit card tips on checks, remember you shouldn't ever see a balance living in credit card tips payable if you're doing a weekly payroll. If you have this in a negative balance, this is then cash outflow. It's just coming straight out of your operating account and into your employees' checkbooks. And this is not money that you've collected from guests. So you want to make sure that you're not overpaying those credit card tips, that you're washing that out to a zero balance every single week. When you're looking at your gift certificates payable, this is the value that is showing you how much is left out there waiting to be redeemed. Again, cash outflow. So this will help you understand how much a liability you have out there that could come back and getting redeemed. No cash flow coming in, so make sure you're aware of that. You also want to make sure that you're looking at your credit cards. Verify that the balances match your most current credit card statements. Also, be really wary. If you have a negative balance on a credit card payable, then that could mean that you have made payments to it but have never reported the expenses. So now your P&L and your net profit isn't accurate because you're not recording those credit card expenses. So always make sure that those credit card balances are accurate. Now, besides that, another great tactic for increasing your cash flow is reviewing your current inventory levels. Chances are you have either altered your revenue for your to-go or you're planning on limited capacity over the next few months as we start to open back up. But plain and simple, your revenue has decreased, and you're going to need to reevaluate your inventory levels to match your reduced sales. Inventory sitting on the shelf doesn't replace cash in the bank. So make sure that you are looking at those inventory levels, reduce them as much as possible, so that way you're only ordering to what you need in sales. Again, going back to what Brian mentioned on forecasting, order to that forecasted sales, not to a specific par. Those pars you had 2 months ago are not the same pars that you're using today. And even for our QSR clients that weren't as heavily impacted with loss of sales, you still need to evaluate if you've got opportunity to reduce the amounts that you have on hand as well. For those of you that haven't ever done inventory, then make sure you are utilizing a declining spending budget week over week based off of these new anticipated sales, so you aren't over purchasing. Again, it's just cash outflow if you're not managing that inventory. Now, there are a couple other ways that RSI can specifically help you in making sure that your balance sheet's in line as well. So if you are looking to fix or research any issues on your balance sheet, or you have items that are being misrepresented, this is where you can reach out to your RSI accountant to schedule a financial sheet review with you. If you're looking to be more proactive in keeping your financials in line week over week, that's when you're going to want to reach out to your operations specialist and schedule a period and review training. Either way, this is a really good reminder to all of you that you have RSI team here to assist you. We do consider you a partner, and we are just as invested into your financial success as you are. So once you've confirmed that your balance sheet is accurate, now you can trust your net profit on your P&L is accurate. But remember, profit doesn't necessarily equal cash, right, Brian?
Yeah, well said, Sydney. So the question is, what is really in your bank account? You may look at the bottom of your profit and loss statement and see a net profit, but then open up your bank account and see, what's in your bank account doesn't necessarily reflect what's on your P&L, what's on the profit at the bottom of your P&L. So remembering that there's a big difference between cash and profit is crucial here. So your bank account is not only affected by profitability, all that balance sheet information that Sydney just talked about also affects that cash flow. So changes in those balance sheet accounts affect your cash flow. So an example is maybe there's a restaurant who's really profitable, but paying off a ton of debt. Or maybe, like the example before, customers are redeeming a lot of gift cards that you sold during a promotion. These are signs of a healthy business. This is a good thing. But a healthy business that might not have a lot of cash in the bank or might not have a really high balance in the bank. That's not necessarily a bad thing, because conversely, maybe you're not a profitable restaurant. Maybe you're hemorrhaging money from a P&L standpoint, but because you've gone and gotten a lot of debt, you're sitting pretty when it comes to cash. Do not confuse profit with cash. All right, so Sydney, that being said, let's talk a little bit about what everyone's dealing with today. So we've talked about cash flow is king. It is king, and it's hard to come by. But we've been working with a ton of restaurants who have had to take a hard look at specific expenses.
Yeah, absolutely. And I'm sure that over the last 2 months since we've gone through this crisis, a lot of the tactics and expenses that we're going to talk about here right now, you've already started working on and addressing. But hopefully if there's at least one that you may not have thought of, then we've given you a tip. So obviously we need to make sure you're aggressively cutting non-essential expenses now. Survival depends on eliminating these non-critical costs that don't negatively impact your ability to operate your food, to go operations, or would hinder your ability to reopen. So let's start going through each of those. So one of the first things that owners start cutting immediately is marketing. And quite honestly, this is the one thing that you should not be cutting. It should be one of the last areas. And if you do cut it, be strategic about it. All your standard rules about marketing pre-COVID are kind of out the door. You're going to have to look at new ideas and you leverage new channels and types of media, et cetera. Make sure that you're really leaning heavily on your community and make sure that you're staying relevant with your brand and your community. That you don't want to cut your marketing dollars, but you want to make sure that you're being strategic about it. And also don't forget that RSI has multiple partnerships with other vendors that can assist you with whether it be updating your website, getting in branding, SEO ad work, but most importantly, building additional online revenue streams. So either directly through your website or through online ordering platforms. We have many partnerships that can assist with this that bring additional savings and value to our clients, but only for our RSI clients. So if you are looking to build an online revenue stream or different revenue streams directly through your website to drive more traffic specifically to that, put in a support request to your ops specialist and get a referral to one of those partnerships today. Now going into some of the other areas, obviously supplies. People are kind of, just as they're managing their purchasing on the food and beverage side, they're also making sure they're reducing kitchen supplies, restaurant, janitorial, et cetera. These should be going down. Make sure that you're ordering smart and keep these purchases as low as possible. Obviously, with the increase on to-go sales and things like that, you might consider looking at different to-go packaging. Before COVID, we were really looking at higher quality to-go packaging that's sustainable. However, now it might be a time when you might want to pivot more into single-use item because of what we're dealing with. But this could also be an opportunity for you to put marketing dollars to-go packaging for branding, et cetera, of your site. So different things for you to think about there. Now, obviously, with the new to-go and curbside delivery, et cetera, third-party delivery is a big one now. Obviously, dealing with higher delivery sales, you are now being more impacted with those fees. A lot of delivery companies offer discounts during this COVID pandemic, et cetera. So make sure you're actually getting those discounts, but keep in mind that a lot of those companies deferred those discounts. You didn't get them abated, they've been deferred to be paid back at a later date. So again, being able to plan when you're gonna have to start paying back those delivery fees. This might be the time, if you are pivoting more to a to-go curbside model, that you start looking at native delivery or bringing delivery more in-house if you're pivoting to that direction. So just some simple things to think about in those areas. But most importantly, let's discuss the variable costs. Reducing your variable costs are often a quicker way to immediately reduce your cash outflows than your fixed expenses. So for example, look for opportunities for reducing contract labor or redistribute your work to a more permanent workforce. This could be actually a real bonus as far as maintaining your PPP loan and the funds that need to go to payroll. If you are able to source maybe that marketing department or contract labor that was a 1099 vendor before, maybe you can put them on a payroll that can act as a head count, and it can also be those payroll dollars that you're trying to pay out over the next 8 weeks after you've been funded. So some things to think about there. General liability, this could be reduced based off of lower sales, or your workers' comp. Obviously your payroll isn't as high as it used to be. So if you are to have a workers' comp that is being estimated off of monthly payroll expense, maybe now is a time to look into getting that reevaluated based off of your new payroll, but also really consider going into a pay-as-you-go program. Those of you that know and worked with RSI, you know that we offer best practices on this, and we really do encourage you to do a pay-as-you-go program so you're not having to estimate and have a big bill at the time of the annual audit. You're paying as you go with every single payroll. This can really help flatten that curve on your cash flow as well, instead of having big spikes when those payments are due. You also want to think about shopping your credit card processing company. In this highly competitive market, you may find someone less expensive, or you might be able to leverage that offer with your current provider and get them to reduce it. As Brian had mentioned, credit cards. Obviously if cash flow is low right now, then use your credit cards for paying some of those expenses. But look at your credit cards. Do you have cash back options? Can you get them to waive your annual fees? Things like that. Your different vendors, maximize your cash discounts from all of your food and beverage vendors. Ask for reduction in dues from your local or national memberships. Drill down into your dues and subscriptions and look at all of those different apps and technology portals you might be using that are charging 30, 25, 40 bucks a month. And are you really using them right now in your new normal? Dish machine contracts. Are you going through as much, loads through your dish machine? Are you going through as much product? Are you on contract with that? Can that be reduced? Cable TV, direct TV, pay-per-view. You don't have people coming in the restaurant, so should you be paying for that expense right now? Trash, reduce the amount of pickups that you're having come to do. Obviously, you've probably already addressed rent and trying to get deferment or abatement from your landlord. But definitely follow up on that if you have it. You also want to make sure you're paying close attention to those vendors who are paid by ACH or credit card. A lot of those are just set up automatically. So you might be paying for services and products that you aren't using right now or no longer meet the needs of your operation moving forward. So definitely look through those and identify those. But another really big way that RSI is helping our clients with reducing expenses is with our purchasing rebate program. So for those of you that may not know, our RSI offers a free rebate program for all of our clients. This is free to you, so it's a no-brainer. You may have other contracts or distributor contracts with vendors, but we can look into what you're purchasing. We can analyze your contracts for you. We can help identify where you might have cost savings, whether it be in food and beverage, or it could be also in linen and to-go packaging or other areas. So please do not hesitate to reach out to us immediately and get more information on the rebate program and sign up for this now. Because remember, we are completely invested in your success. So we're constantly trying to find ways to bring savings to you.
Sid, it's a good reminder, and I also want to bring everybody's attention to the email address up on the screen right now, the RSI purchasing at rsiaccounting.com. If you want to know more about this program, if you're not sure if you're signed up for it, reach out. We have a purchasing team who'd be happy to help. So please, again, don't hesitate. Reach out. Remember, you have all these resources at RSI. Make sure to be using them because like Sid said, we're invested in your success. And that being said, it's time for another poll question. Okay, so it should be up on your screen now. And the question is, what expense that you cut has had the largest impact on your cash flow? You may say utilities, you may say marketing, insurance premiums, lease amendments, or you may say direct operating costs. So I'm curious, we've heard a lot of different strategies out there and costs that have been cut. I'm curious what everyone says, so I'll give another 5 or 10 seconds to get those answers in.
Might be all of the above on that one too.
Might be all of the above. Should have put in all of the above in that poll. All right, I'm going to close the polling. Came in pretty overwhelming that the most successful one, or the largest impact, as the question states, was lease amendments. Probably not too surprising, right, Sid?
Not surprising at all, and I think that actually goes right into what we need to talk about next.
Yeah, so we mentioned it, Sydney mentioned it a little bit before, but we're hearing a lot about deferrals and abatements, and a lot of restaurants that we're working with and a lot of restaurants out there have had to have conversations with all their vendors, and deferrals and abatements are a good strategy. I kind of want to take a step back and start first by just defining deferral and abatement, because they get brought up together a lot, but they're really different. Deferral means you're gonna eventually have to pay that. It may help with cash flow to put that expense or that payment off for a certain period of time, but you are going to have to pay that down the road. An abatement is a negotiation where you either lessen the expense or pause the expense, and you actually don't have to pay that back. It's important when you're having these conversations with your different vendors or your different partners to understand the difference and make sure that's clear with everyone. The biggest thing I hear is someone thinking, oh, I'm excited, I have a deferral set up, and really not thinking about the cash flow impact down the road. Up on your screen right now, there's some examples of ones that we've heard about being successful, probably some of the more common ones. The first couple, the royalties, the franchise fees, probably speaks mostly to the QSR franchises that we work with, but I've heard a lot of good stories about franchises working together and coming up with deferrals or abatements of those royalties or franchise fees. Rent, from the last poll we did, obviously rent has been a big part of that conversation, and coming up with a deferral or an abatement there, having that hard conversation with your landlord. I've heard of restaurants deferring taxes. With all your vendors that you're working with here, the importance is that it's a win-win situation. They should be invested in your success. They should want you to be as successful as possible, because that's good for them as well. So approaching the negotiation that way has been really helpful from the restaurants I've been working with. Some things I want you to consider as you're going through all of these, though. First of all, the first one, tracking due dates. That speaks specifically to deferrals. Here, you have to be real organized, and you have to come up with a 30, 60, 90-day schedule plan of your cash flow. And if you're setting up negotiating terms or setting up deferrals of some kind, make sure you don't get caught by surprise. Make sure that you have the cash available when it's time to make those payments that you've deferred or the longer terms that you've negotiated. And also a cash influx, being strategic about when you need those cash influxes. Some you have control over, some you don't. But the more you're forecasting your cash flow, the more you know, okay, well, I'm getting some government assistance here, maybe through the PPP loan. Maybe I'm just getting a traditional loan, and maybe I need it here so that I have the cash flow, or maybe it's a line of credit I'm dipping into. Whatever it is, be strategic and plan out when you're going to need that cash influx. That's been really successful with the restaurants I've been working with, but I can't say it enough with those deferments. Track when those expenses are due. Yes, this helps with cash flow in the short term, but it could also give you that false sense of security because you have cash in the bank account. So stay on top of those due dates, plan ahead from that cash flow perspective. Don't get too comfortable just because you have money in the bank, right?
Yeah, and one thing I would add on that as well with the PPP loan, if you don't use 100% of the funds and you do take a loan out on the remaining balance of unused funds, that's going to start hitting in November. And typically Q4 is probably a real great cash flow month, increased revenue, gift card sales, etc. However, now all of a sudden in November, you're going to have to start making some pretty large loan payments if you didn't use all those funds. So keep that in mind that Q4, A, we may not be, pre-COVID sales, and B, you may be having to start paying some money back on loans. So it's going to deplete that cash. So just something to think about when it comes to that PPP loan.
No doubt. Okay, let's get back to the initial slide we had in the presentation today, the EKG chart, the ups and downs of a restaurant and all the things, all the events they have to deal with that have an impact on their cash flow throughout the year. So we've talked about some different tactics that could help with this challenge. When are you going to pay off debt? When are you going to use credit cards? When's that government assistance coming in, or the PPP loan? Have you deferred certain expenses until your revenue is stronger? When do you have enough money to purchase those or pull the trigger on those capital expenditures or reinvest in your business? Reviewing these cash inflows and outflows and planning strategically throughout the year is going to help you flatten that cash flow curve. What do you think, Sid? It looks pretty flat to me.
Well, it takes work, but I know you guys can all get there. Really quite honestly, the great news is that no other small business owner category has the tools or DNA necessary to pivot as well as the independent restaurant owners. You guys are amazing, and this will be the greatest age of innovation for you and the restaurant industry, and I couldn't be more excited to see how we're going to thrive through this. And I know you will not only survive, but you will thrive.
Well said. Okay. One last poll question. By now you know the drill. Should be up on your screen now. Now that you have seen resources available to you to aid in cash flow management, which one are you the most likely to pursue? Is it going to be period end review training with your operations specialist? Is it going to be financial sheet review with your RSI accountant? Is it going to be budget building with your client advisor? Or is it going to be a break-even analysis with the client advisor? All right, I'm excited to see what people are going to be reaching out for. I'll give about 10 more seconds for everybody to get their answers in, and then we'll talk about Sid. I'm going to give you a little bit of a teaser. It's looking like we're going to be busy in the client advisor department.
Certainly hope so, but don't forget to be reaching out to that purchasing department as well, because that will be helpful too.
Good point. Okay, I'm going to go ahead and end the polling. Sydney, a little bit of a mixed bag. A lot more break-even analysis. The good news is we're getting really good at it, right? Doing a lot of experience there. And some budget building with client advisors as well. So for those of you interested, we're going to, again, we'll get our contact info to you, but please don't hesitate to reach out. That'll be a lot of fun.
We're ready.
All right. We're ready. We mentioned that that we'd leave some time at the end for some questions. I saw some questions come in, so thank you for those of you who have gotten your questions in, and we're going to address a few of them now. Okay. This one's for you, Sydney.
All right.
I read something saying that you can't get forgiveness on your PPP loan if you defer your payroll taxes. Is this true? So there's been tons of confusion about the PPP loan. It's even a little bit of a moving target, right? Not everything's all the way clear right.
Absolutely. I mean, even as last week on Friday, there were changes to some of the stipulations from SBA on it. So, first of all, thank you for the question, and it's a great question. For me to be able to properly answer that, I probably would need a little bit more information. What specific payroll taxes are you talking about, which got deferred, et cetera? But the great news is that RSI has a full compliance department dedicated and has literally been working around the clock since March 15th when this, everything hit the fan to help our clients answer these questions, be prepared for whatever is going to be needed, and to be able to react accordingly. In addition to that, we also have a Ppp Task Force that we set up as soon as COVID happened that is dedicated to all of our clients and assisting them with any PPP questions, whether it is to do with the application process or after where you probably all have been funded at this point, okay, what can be deferred, what can't, how can it be used, et cetera. So feel free to reach out to our RSI Compliance Department and the PPP Task Force for answers to those specific questions.
Yeah, it also, and absolutely reach out. Also available on the education and training if you're an RSI client on the website. There's some frequently asked questions that I've found pretty much it's a good summary of all the questions we're getting. Yes, there's some particular one-off questions that a conversation may be a little better. So reach out, but try that frequently asked questions as well. I've had a lot of clients give me feedback that that's been helpful.
Yeah, and for those of you that are not currently RSI clients, you can access all of our podcast blogs, webinars, FAQs, all on our website as well. So feel free to go to our website to research any of that information.
Okay, let's try to get to another question. Have you thought about how restaurants will do a limited capacity opening? Yeah, this is really the next step. So it's going to be different by state, and it's going to be different with every local government as well. And we're hearing there's almost always different phases, and maybe you can open at limited occupancy with different rules in place. It's a lot to sort through and sift through, and a lot to think about as to when should I reopen, how do I reopen, can I afford to reopen? A lot of these questions are coming our way. Sydney, the good news is this speaks directly to the next webinar we're doing in a few weeks. We're sifting through all this, trying to put it in an organized fashion, and I would encourage you to join our next webinar that will be coming up towards the end of the month on reopening strategies as we try to sift through all the different strategies.
Absolutely. And with that specific question, and thank you for asking it, again, that goes back to, let's start with a break-even analysis, because that's going to be the starting point to help to identify whether or not a limited seating capacity is something that is doable for you. So don't hesitate to reach out to Brian and myself. The break-even analysis we're doing for all of our clients. We're happy to do one for you as well. So don't hesitate to reach out after the call today.
Perfect. And I saw another question come in, Sydney. Will there be a demo of the cash flow sheet? So statements that post to RSI, for RSI clients weekly, we have the balance sheet, we have the profit and loss statement, and then those two work together, and you also have a cash flow statement. And that's a hard statement to sift through, isn't it?
It can be very confusing. So We didn't include a FAQ on understanding how to read the cash flow statement, but if you are having questions on how to review that, reach out to Brian and myself. We'll be happy to walk through it with you.
Great. Well, thank you so much for those of you who got questions in. We'll be sharing a recording of this whole webinar in training and education, and we'll send you a follow-up email in training and education as well.
And for any of those
up on the screen.
I was just going to say, for any of those questions that we didn't get to this morning, we will respond back to you afterwards. Thank you for your questions.
Absolutely. And if there's questions that you didn't get a chance to ask as well, our email address is up there, the client advisors at rsiaccounting.com. You can reach out for that break-even analysis if you just want some help there. You can reach out for budget strategies and budget building, or if you just have a question that you weren't able to get in on this webinar, don't hesitate to reach out. The phone number is there as well. Thank you so much, everyone who joined and participated in the call today. It was a lot of fun. Sydney, thanks for your time too.
Thank you. Thanks, Brian. Thanks, everyone, and have a great day.